Thank you very much. As already introduced, my name is Fabian. I head the team at Centenary Bank. Centenary Bank is having slightly over $1 trillion Uganda shillings worth of assets, 85% of which are financed by savings. Like any commercial bank, there has been quite a lot of focus on encouraging as many Ugandans as possible to do savings. Of course, having appreciated the importance of this particular element. And over time, for the last 27 or 28 years that this bank has been in operation, there has been quite a lot of focus on the supply side, on encouraging savings, as well as on the demand side. Looking at the supply side, the focus has been on trying to see how costs or transactional costs of operating savings can be lowered so that as many people, both the poor, the previously excluded ones, can be availed an opportunity to work or get involved into financial sector. And the focus has been mainly on channels of distribution. This bank currently boasts of 58 branches, and they'll be putting up another 5 before the end of the year, reaching almost all corners of this country. And with a strong network of ATMs, currently 142, which is about 25% of the network of ATMs in this country. On top of this, again, in the quest to focus on channels of distribution, there was an introduction of a mobile unit that could supplement these fixed shops or places of service, again to try to reach out to as many people as possible. And most recently, the bank has introduced a channel whereby clients can use their telephones to access their accounts wherever they may be. We believe as a team that this is going to be a key development that will be able to enable as many people as possible. Again, on the side of the demand side, or rather the supply side, a lot of products have been developed over time. Those focusing on various sections of the population, those for the youth, those for business people, those for the young, and very soon efforts are on to try to design products specifically for women, again as a way of involving all those who had been previously excluded from financial services. Of course, one of the key underlying thing has been affordability, emphasis on affordability, and probably we can say this is a bank that offers the most affordable savings account in this country, and probably that's why it currently serves almost a quarter of the banking public in this country. Of course, we noted again recently when we tried in a way to try to make people feel as comfortable as possible, there was an introduction of an alert system whereby anything that goes on onto your account, people are alerted. Of course, initially, there was a challenge where because of this, they were being charged a small fee. Some people, requested to opt out. But as we speak, many of those who wanted to opt out have come back and said we need to, it's a very good service. So we believe through all these efforts, we've been able to attract as many people as possible. On the demand side, again, we note that we have knowledge gaps. People, even when products are introduced, they may not know about them. Even when all these services are introduced, people need to be trained about them, sensitized about them. And that's why the bank has invested heavily in financial literacy campaign to try to train people and sensitizing them on the importance of doing services, rather savings, and other banking facilities that this bank offers. I guess for now, and we'll be happy to discuss any other intervening questions as they come along. Thank you.
So hi, my name is Billy Jack. I work at Georgetown University. I'm the co-director there of something called the Georgetown University Initiative on Innovation, Development and Evaluation, which has a much shorter acronym, which comes out as a guide. This is our attempt. I co-direct that with a colleague, James Fabian, who's Ugandan. So I wish that he would be with me today to show me around Uganda a bit. He and I have been working together for about 8 or 9 years on development projects. We're both economists, and we've set up this little joint to help us do that more efficiently. We involve students quite a lot in that enterprise, which works well until they graduate and they go and work for IPA. So we hope to retain some of them. So some of our research over the years, and this is not just with James, with other co-authors as well. I've worked a lot with Fabian, who's a Kenyan, on M-Pesa. I'll talk about that a little bit tomorrow, that particular study. We've worked also with a leading micro health organisation in Kenya, from whom you just heard, Changamka, looking at evaluating some of the impacts of what they do. We're doing a project in Kenya on mobile trade credit at the moment, looking at the business use of mobile money to improve the efficiency of small retail, so the small retail sector. We've got a few other RCPs as well in the mobile space. We don't just do mobile technology stuff. We also are interested in things that are pretty hard to pin down, something like accountability, citizen agency, motivating people to help themselves and stuff like this through various forms of communication and messaging, etc. One instance of that was a financial literacy project we did last year, where we worked with 220 schools in Kenya, high schools as well, not little kids, and tried to get through to them through comic strips and other means of communication that they may or may not have been more willing to or able to access. We also did work on water and sanitation, looking even at integrating issues in that area with mobile technology to see if we can improve governance as well. But I'll stop there. Thanks a lot for inviting me to join.
So this being back here again gives you an opportunity to tell you a little bit more about the work that we're doing with young people, but also with adults in the area of financial inclusion, specifically in Africa. So earlier on I mentioned that we're working on this project, Advancing Integrated Microfinance for Youth in Mali. And there we actually have 2 different approaches that we're testing out. One with youth savings groups, so following the same methodology that Bram mentioned earlier on with the Saving for Change study, but adapted slightly to youth. There's really not that many differences in the methodology itself. It's really more on the outcomes. But we're also testing out group savings accounts with credit union networks. Using this very similar methodology of the youth coming together on a regular basis to save, but there's no credit component on that, and it's an actual formal savings account that they open up together. And so what that allows us to do in terms of financial inclusion is, especially working with young people in rural areas where there's no financial mechanisms, no formal financial mechanisms, the youth savings groups allow them to have something that they can utilize and leverage. We're also working with adults, very much following the same type of approaches, working with credit union networks, but for adults we're doing actually credit with education, so using credit groups as a platform to deliver other services such as health and education. And we're also doing the savings group methodology under Saving for Change. And so one of the things that we were asked to do is to talk about one present thing. And I think particularly for young people, especially in rural areas, is how do you provide services to young people living in rural areas in poverty? Young people who are going to be migrating. And the way to think about it, and we haven't completely solved the riddle here, but is to think about a continuum of services that can accompany a young person through the various stages, through the various life stages and the various life needs. So for example, you can start with the youth savings groups in a rural area when young people are adolescents. And, but then, some of those youth, many of those youth are going to be migrating. So then linking them to some type of financial service that they can tap into as they migrate to an urban setting. So that may be, perhaps with the advent of, a more mobile banking in West Africa, that can be something that can be, utilized. And then that can be then leveraged to formally include them into the formal financial service sector, so providing them credit as well. So kind of if you think about it, it's a graduated approach. So that's one of the things that I think we're very interested in trying to pursue further. And this conference actually gave me a lot of really good ideas.
Thanks. Fantastic conference thus far, and thanks to everyone for the contributions. Learned a lot today. So I'm leading our work here in Grameen Foundation in the Applab. I've been here for the last 3 years, but my background is really in mobile and services to last mile consumers. And so I started off really in the information exchange space, but have moved into the financial service delivery space over the mobile phone, and learned a ton over the last 3 years. Our Applab here is really focusing on going from idea to market with solutions for the poor and the poorest. And we do that through a combination or triangulation of research methods, so quantitative, qualitative, so user-centered design, and then also data mining, because technology allows us to have access to huge amounts of data now that we didn't have before, and we can collect that at very low cost. So we're also running here in Uganda a vast network of what we call community knowledge workers. And we're running that as a social enterprise. And we now have 1,200 of those stretched across 36 districts, serving poor communities with agricultural extension information and collecting data using smartphones. And we're really now starting to work with microfinance institutions to actually open up that channel for financial inclusion as well, and really looking into branchless microfinance models at the moment. So I think it's no surprise that Africa is leading the world in growth of mobile communications. Asia is more connected, but Africa is growing faster. I heard Nokia made a prediction that within 2 years, actually 30% of the connected Africans on the continent will be actually using smartphones. And that's really an interesting new channel that's opening up when we think about the fact that M-Pesa has ridden on the rails of the SDK inside the mobile phone, or USSD, which is a really limiting technology. I think this window of opportunity of being able to interact in new and different ways with the poor is going to be very exciting. So I think my comments today will focus within that context. I'll leave it at that, and looking forward to a good discussion.
So let's get right in. And I don't have questions yet from any of you, so I'm going to start with my own. And soon you'll notice your questions are better than mine, so you'll send some in. But I thought one sort of light theme to start with is maybe to think about behavior, and how do we as individuals sort of pick up and pursue certain behaviors, and what are all the different ways in which behavior is influenced. And let's think maybe specifically about savings as a habit. So some of the comments from the first session today were around how advantageous is it to start young, to have this inculcated at the level of the school, part of the curriculum of what young people learn. what is the role of the family in how sound financial practices are shared? What is the role of the institution? Julie was giving examples of instances where institutions do not make it easy for people to follow through on behaviors which are beneficial. So what is the role of the banking sector and financial institutions? And finally, of course, what's the role of the public at large and government as an embodiment of sort of what goes on in the public space? How do these different actors contribute to sound habits when it comes to financial practices? I'll let it be open, but maybe Fabian and Rossana can take a first crack from the bank perspective and maybe from working with young people.
Well, thank you very much. Of course, we all realize that driving behaviors is not easy, especially when there are behaviors to do with postponing consumption. And as financial institutions, I think we do realize this. At our end, for example, at Centenary Bank, we know that creating behaviors of young people needs a careful plan, investment. That's why we initially went out to design a product specifically for the young and the youth, and also not to expect a return immediately. So as a financial institution, these are some of the products you want to look at as an investment for the future, making these products easy to be accessed by these people. And you'll find these products having no charge, for example, as opposed to other products. And also, if you are to cost them, to know that they are not going to make money, but rather you want to drive as many of those numbers as possible, so that possibly in the future, they will begin to make money. Of course, we know from experience that when somebody has been banking with an institution, it becomes very difficult to change in the future. And as one of the strategies, on top of the strategy to ensure that the product is designed with some of those conducive features, is to try to locate as close to these people as possible. So you will find a shop or a branch near a university, for example, or near schools, and you'll also find the bank trying to do, corporate social responsibility activities in some of these institutions as a way of encouraging and crafting behaviors of these young people, and also to enable whoever are the benefactors, people who are, financing these people, to find it easy to encourage these people to save, either by way of remitting some little money off their accounts to their accounts. For example, when you talk about the telephone banking, the Central Mobile product that was introduced, this is a product we are telling these people who are supporting the young people that it is a very easy thing. Anytime you want to encourage somebody, just sit down in the comfort of wherever you may be. You transfer 100 shillings, 200 shillings, and make these people view their accounts to see how they are growing. That way encouraging them and hopefully eventually having them to take up the habit of saving.
Great. Well, this topic of savings habit is very, very dear to my heart because I'm in the process of finalizing a discussion paper with one of my colleagues, Laura Fleischer-Munyonyo, on group-based approaches to promote savings among young people. And in the paper, we argue that a group approach can be very powerful with adolescents because adolescents, I think a lot of us are particularly susceptible to peer influence. I think we've talked about that many times throughout the day today, but especially adolescents. And if that peer pressure can be leveraged and channeled in a way that can promote positive savings behaviors, for example, through savings clubs, types of savings clubs that Applab promotes, or the savings groups that are promoted through the Saving for Change methodology, where youth come together on a weekly basis to save. That can lead later on to lifelong habits. There is a paper by New America Foundation. New America Foundation is a think tank out of DC that they put together maybe about a year and a half, 2 years ago, on accelerating financial capabilities among young people. And actually, that's the precursor paper, sorry. The new paper that they built was called Creating Creatures of Habit. Sorry about that. But both papers are really fascinating and they build on each other. But in this paper on Creating Creatures of Habit, they argue, they present this theory. They draw from a couple of different authors, but this theory that you can create a savings habit loop by having a routine, then a cue, and then a reward. So if you think about, for example, the example that they give is going to the movies, and you go to the movies on a, and the cue is that the movie starts and you're immediately cued into eating popcorn. At least that's what I do. I don't know about you guys, but that's what I do. And then you're rewarded because you're watching the movie and it's so enjoyable and you're just eating and not even, seeing how quickly you go through the, massive bags that they sell in the U.S. And so it creates this habit loop that every time you go to the movies, you end up, buying your big thing of popcorn and eating it. And so, again, the idea is that you create a routine, for example, with a savings group meeting every week. The cue is that you're called into savings, So-and-so name is called, and they go ahead and put in the savings. And the reward is that they see their savings growing every week, and they can access those savings by borrowing or when they do their cash out. And the idea is that can create that kind of a savings habit early on in life, with the theory that will stay through their lifetime. But again, that's the type of research and evidence that we need more of, to see if that really holds true over time.
I can just comment quickly. I think that it's pretty obvious that knowledge is not what will drive saving by young kids. They don't need to know about compound interest. They need cool guys who save. They need aspirations, I think is important. So my question is, what are they going to save? They don't have a regular income to save from. So if they're saving anything, it's probably coming from some unexpected, source of money. Excuse me. And when you think about poverty, poverty is the status quo, and you expect to be there all the time. And so if something good happens, you just go for it. You spend it all, because you're going to be pouring into it. So if kids' aspirations could change somehow, then they might, think maybe that's not going to be the status quo. And how we change aspirations, I think I have no idea. But it seems to be nothing to do with standard education about compound interest or good behaviour. It's more about aspirations.
Fantastic. Wonderful. So related to that, I have a question here, which is around the offering of incentives. And this is something that Simone also has worked on a bit. What effect might a financial incentive, like an interest reward, have on the take-up, usage, and long-term behaviors of youth and adult savers? And how does this help differentiate formal products from informal sector offerings? This is from Erin at the Global Outreach Alliance. Who would like to start with this?
Well, there'll be an income and substitution effect. So the impact is ambiguous.
Yeah, I think on the face of it, incentives, you would think they would drive savings. But after they get the incentives, if they haven't, taken up the habits, the savings, they will take back their money. So, and of course that comes from, I think there was some research which was conducted, at least in this place, and it was noted that people save not necessarily because they want to have a high return, but majorly because they want to ensure that their money is safe. Safety is very key. So you want to ensure that people feel safe when they keep their money with you. You want to ensure that there is accessibility every time they want it. Return comes, a little later, possibly third or fourth. So I think safety is very critical. Incentivizing, it is a short-term thing. You incentivize, they will save. You know, we've been conducting campaigns, for example, once in a while. You conduct a campaign, deposits grow to a certain level, then after some time they go back to where they were, meaning that incentives are a very short-term thing.
I'd like to add something on incentives, particularly with youth. We asked youth through a number of focus group discussions, so this was more qualitative research work, and this was done in Ecuador, about the incentives. So we asked the youth who had opened up savings accounts, as well as those who had an open savings account, what really motivated them to open up savings accounts. And we also asked the staff. What's interesting is the staff said, oh yeah, it's all these little incentives, we need to do more of that, like the t-shirts and this and that and the other. But when we asked the youth who opened up the savings accounts, what motivated them, can't say the word in English, motivated them to open up the savings accounts, they basically, most of them said that something to do with the talks that they were given, the financial education, or their parents influencing them. None of them said anything about the incentives. And the youth who hadn't opened up the savings account said things along the lines of like, oh, I don't have time, or it's too difficult, or the process is so difficult to do. And so I think, I don't have all the answers to it, but what that research made me think of is like, we need to understand better, whether incentives really work or not. There may be, I'm not saying that we have to do away with this, incentives, but they may be more of a marketing tool rather than actually motivating people to either save or to open up savings accounts. As you were saying, I mean, the incentives can be really, really expensive. So we also have to think a little bit about, value for your money. But I think it's just a lot more complex, and I think t-shirt or even interest rates, I'm not really sure how effective that is. There's a paper by some Chilean guys called Under Savers Anonymous, Felipe Cast, and that paper. And there they measured, they looked at the difference between the influence of self-help peer groups versus interest rate. And I think the self-help peer group had more of an influence in savings than the interest rate that was being offered. So again, just something to think about in terms of incentives. There may be a lot more to the power of groups or personal connections than actual material incentives.
Yeah, maybe I'll just add, going back to a lot of the discussion in the morning around goals and commitment savings. I think the non-financial is pretty powerful. It's what we're seeing out in the field here in Uganda. People have loose goals, but it seems to be a strong motivator for saving. The question that is on my mind is how to get that saving into the e-wallet, because right now it's primarily a pipe to move funds around. We're not seeing a ton of stored value. Interesting experiment going on in Kenya right now that was talked about on the last panel that is very much a financial incentive. So it'll be interesting to see where that goes. I'm sure some of you are researching that as we speak.
Certainly, that is a ripe area for study. And just to add on to Rossana's point, I think the verdict on incentives versus knowledge-focused interventions is still unclear. It's a diversity of results from different areas, and I think part of it is to sort through it to see what is more consistent and how can we make sure that the tests lead us in one direction or another. But with that, maybe we can turn to a topic that Sean will be very happy to discuss, which is on sort of what is the transformation that we expect from mobile money. And maybe some comments around why do we see such different experiences with this technology across the countries, even in this region. What have been some of the drivers or the barriers to having mobile money become an actual channel for financial inclusion? And to that, I will add another question from the audience, which is addressed to Billy Jack and Sean Krepp from Stuart Chernell at ID Insight. Could you possibly discuss the benefits and drawbacks of large observational data sets, either through SMS surveys or sometimes it can be transactional data, versus using randomized control trials for informing policy?
Well, I was already touching on one of these first points that, you know, I think if we look at all of the implementations of mobile money around the world, it's still largely a payments ecosystem. So how do we basically create a system that offers a full range of financial services and products, things that can help poor households manage risk, build assets, smooth cash flows, and secure lump sums? I mean, these are the things we're trying to drive towards. What we see, though, is it's not as easy as it looks, and there are a lot of barriers along the way. And we're still trying to fight the mattress and get the savings out from under it. Our hypothesis is really that we need to build the ecosystem, and that means the partners, banks like Centenary that have a large on-the-ground presence, but also, and we heard the comment from Bankable Frontiers that the products we do think are broken, and we do think more co-creation with the communities we're trying to serve will help fix some of those challenges out there. But then again, the not so fun stuff is really the delivery models. And you know, I was talking to Billy earlier, and you know, the big innovation of mobile money was really the human side of it. The technology helped, of course, and was an enabler, but actually it's the agent networks that are creating that trusted contact with the rural communities, and that's what's really driving the uptakes of payments. So how do we leverage and how do we look for innovations in that delivery model to ensure that we build upon that, build upon the early successes, but also analyze those failures and make sure that as we do move towards this hopefully personalized portfolio of products that we can deliver over that network, we do it in such a way that we build more of a relational type of model and less of a transactional one. I think the last thing, and this is probably for discussion from everyone, I think one of the biggest challenges we're facing is the regulatory one. This is such a nascent technology, and you know, how do we have a gradated system of pre-banked transitioning to banked, and what's the role of mobile in that transition? So if an MNO, mobile network operator, is an issuer of an account, what does that enable them to do in a sort of pre-banked setting? So does a SIM registration act as a proxy for KYC? What are the agency rules that they're going to be subjected to if they're serving, you know, really the under or unserved or unservable? So I think all of those questions are still open. There's still barriers and lots of room for discussion, especially as we heard the regulators talking this morning that they really have on the table right now agency banking here in Uganda, as well as guidelines on mobile money regulation. So it's a hot topic here, and it certainly could make or break the future of mobility and mobile financial inclusion. Just to conclude on a final comment, I think we all agree that mobile money does not equal financial inclusion, and there's still a ton of work that we need to do and a lot of research that needs to go on to make sure that we're doing evidence-based work as we explore this new huge opportunity for you know, helping to bring the world's poor into the financial system.
Sean and I had an agreement that that was going to be my line. See, that's the problem with any kind of financial product that relies on trust. Right? You just go like that. No, so you asked about, you know, why mobile money is working in some places and not others. I think, and this leads back to actually one of Julie's points, that Sean just reiterated about the products, how they're designed. I think M-Pesa was designed with in a context in which there was a very clear demand which was being unmet. That was to transfer money over large distances in the country. That demand is perhaps, and I don't know the demographics of all countries to be sure about this, but is perhaps more acute in Kenya than in some other places because families live all over the place in Kenya. They're always split up. So there's always a need to send money home, which was how it was marketed originally, of course, as you know. So there was a demonstrable need, and I think Safaricom designed the product for that need, and they designed it well. So it worked, and not only did they design it, they put in the infrastructure, that is the agent network, for it to work. So they didn't put all the agents in Nairobi, they put them all over the place at once. That takes a lot of investment. You're bound to lose money for a long time to start off with if you build that bigger network to start with, but that makes it a good product. So I think the demand was there, and the knowledge of the customers' needs was there too on the supply side. So I think that's one of the reasons why it's worked better in Kenya than other places perhaps. And I agree entirely, it's nothing about the technology. It's all about management and the organisation of the agent network and the size of the agent network. It's been important. One issue that's come up is interoperability, which is a big word. And it seems like a scary thing. I think this is actually not at all about technology, but all about regulation. And it's about pricing. And this has been, addressed in many other markets in the world, from railways in the UK to telephone companies in the US. We never had a problem sending a text from one carrier to another. We should be able to figure out how to send money from one carrier to another, which you can do, by the way. It's just expensive, right? So it might be an issue of regulation which needs to be looked into more closely. On the other hand, I think Kenya's example says whatever you do, don't over-regulate this thing to start with. They took a little bit of a bet, I think, in Kenya, the central bank, kind of letting things run a bit at the beginning to see what happened, and things turned out so well, quite well so far. So good. In some aspects of the competition policy, at least, might require more regulation. There was a question from the floor about large data sets. So, having used a large data set with some, I don't know about success, but without getting thrown out of the room, I can say that there are obviously good things in some contexts. There is a curse of large data though, and that is that everything you look at is going to be significant. So you won't be able to say that nothing and some things don't matter. Everything will matter. The problem, of course, is that you might be looking at rubbish in the sense that you might not identify things very well. So I think of this as like having a torch. A large data set gives you a very, very strong and precise beam with which to look at something. But if you can't do an RCT, then you might be looking in the wrong place. So RCT, which has smaller data normally, has a wider beam and fuzzier kind of display, but at least you're looking in the right direction. You are the middle of that beam is the effect that you're looking at in some sense. Right, so there's obviously a trade-off. I've read papers which have used huge data sets with billions of observations, and they report significant effects. And when you work out how big those effects are, they're in the orders of cents, they're US cents, right? Tiny, tiny, tiny things. But they look big because they're statistically significant. So we have to be careful when interpreting them, but I certainly wouldn't not use them.
If I may also ask Fabian to comment on, maybe a little expanded, what do you see as the role of government in making financial inclusion easier or more difficult around different aspects, whether it's fees, whether it's regulatory issues, approaches to risk, any of those items, in your experience?
Well, government has a very big part to play. We are talking of things that affect savings. We are talking about transactional costs. We are talking about trust people have in the financial system. We are talking about other behavioral issues, knowledge gaps, and so on. And all these are things where government can play quite a big part by way of policies that would make easy for financial institutions to deliver services, by way of investment in infrastructure, so that at the end of the day, financial institutions that are operating, in those faraway places, they don't find it very expensive to deliver these services. So at the end of the day, these services are affordable. We are talking about, of course, in the morning we heard of the policies that government, central banks are coming up with regard to money transfers, mobile money transfers, agency banking. These are all areas, I think, where government can play quite a big part to try to enable, service providers, like the financial institutions, to deliver service to the previously excluded people.
Great. Thank you for those responses. We have a question here from Eric from Access to Finance in Rwanda, which is very interesting and very political. What should be the role of development partners and donors towards financial inclusion, taking into account both sustainability concerns and market distortions? And I think that's great because we are talking about several institutions like that influencing the sector. So.
Well, maybe I'll start on this one. I'm a kind of a practitioner, so probably be good for me to answer. Basically, I think donor money should go where there's a market failure, first of all, and buy down some of the risk, pay for some of the experiments. But then, as we start to see the evidence emerging and we start to scale, or we see the private sector entering, or the government delivering service, that's when I think NGOs and donors should step away. I think it's.
Do you see that playing out?
I think, if I'm thinking about our own organization, we've exited from a few markets, so to speak. We have a capital markets group that was doing microfinance loan credit guarantees, working with banks. And that was because we didn't see credit flowing to microfinance institutions. But then as soon as that became pretty much a standard product in some markets, we closed up shop and left.
Well, yeah, at the very start, when efforts started to try to evolve a financial sector, financial systems, of course, government partners like donors came into play. And they got to be known for, at that time, being people who are giving grants or giving incentives. But over time, I think it has come to be understood that for sustainability purposes, instead of going into grants and incentives, they would rather, get involved in capacity building, in infrastructure that would enable institutions to begin to play their part to sustainably deliver those services. And I think it is now understood, and that's where we expect the government partners to be playing a part.
And just to add, do you feel the priorities are aligned most of the time, or are there serious contention, like anything that you can discuss in public, not because I know a lot of these conversations are hard, but do you feel that the interests are mostly sort of aligned in these discussions?
Of course, at the very start, usually it is very difficult to align the interests because development partners will come with their plans, with their goals, with their strategies and so on. And then when they find institutions on the ground, usually they will also have their missions, their strategies, their plans, and so on. It is very important they all sit down before they finalize the project, for example, to have aligned, their goals, so that they are all on the same page. In the past, you would find a financial institution or an organization which is being assisted, and then when it is left to move on its own, is not able to sustain, whatever it has been doing. Mainly because the goals initially were not aligned with the mission of those institutions. And I believe over time, I think this is the thing that has been appreciated. We are increasingly seeing development partners who have come in with their plans, sitting down with the practitioners, with the institutions, to try to align and finally agree on a plan of assisting these institutions.
Well, maybe I'll talk about our partnership a bit, because we're partnering with Centenary on actually creating new products using the mobile channel. And I think a big effort involved in that has been the strategic alignment, where we spent a lot of time, and I have to say a lot of kudos to his executive leadership team, who's been actively involved from the beginning at setting the strategic targets, making sure there's alignment. But then I don't think we stop there. We go down into the organization, to the product development team, to the owners of the channels, to make sure we're completely aligned at all levels of the organization. So there's a lot of change management as well that takes place.
So we have a question here, which is, I'll let you take it as you want. But what has had the greatest impact on financial inclusion in Africa? And maybe we'll set a time frame in the past decade or so in each of your views. What has been one thing that has really driven a change in tempo in financial inclusion?
M-Pesa.
Nobody else can say M-Pesa.
That's what I said.
I'd say, well, the innovation of microfinance being non-collateralized credit. I think that's made a huge change. And how that translates into the mobile channel now is going to be interesting. Working with some ag finance organizations, there's some innovation going on mapping using GPS, the arable land for a farmer, and using that to actually look at production capability, and then providing credit against some non-collateralized assets for land. And we were talking earlier about how to get women more access to finance if they don't have traditional access to land, but they do have a piece that they can grow on. This opens up more opportunities for them as well.
I think in financial services, you can't miss the issue of trust. I think trust is very important, and if we talk about this economy, for example, in the 1990s we experienced a couple of bank failures, and in the process, a number of people kind of lost trust, and you could see a reduction in participation and inclusion of people. But over the last decade, I think we've had smooth transition. We've had a couple of good regulations from the regulator, the central bank, and government. And the process we've witnessed increase in trust, increase in competition, increase in economies of scale, and increase in transparency. Three things which are very key to ensure that at the end of the day, the people who are using these financial institutions get value for their money. And I believe if those three things are driven further, we should be seeing a little more inclusion, getting more people get involved in the financial sector.
Well, I think I would say that's a tough one to do, the last one here, but let me see what I can come up with. No, I think just the awareness of the need to build the financial capability, especially of young people, because as I think there was some, some comments made earlier on, not having enough financial literacy is going to keep people from being able to really utilize financial services appropriately. So I think whether financial capability is built through financial education and access, better access and usage of financial products, or maybe more financial education, or whatever mechanism or strategies is utilized, but really being aware that that needs to be built to really lead to greater financial inclusion.
Wonderful. And I just wanted to quickly follow up with either Fabian or some of the other folks on this question. How in your view, do people perceive trust in a bank versus a telecom? Very quickly, I know, because we're running out of time.
Well, I guess for a telecom mobile money, you are just transferring very quickly. You transfer and it's gone, done. But now when you are dealing with a bank, your money sits there. People, something which is instant, probably they won't worry much about whether money will be safe or not. And probably they don't even expect that institution to keep their money. And the thing that was being talked about, that we need, when these telecoms had just come, people were laughing at financial institutions, at banks, that they've lost relevance. These guys have come to take up the space of banks. But we kept telling them that this is going to be complementary. It is just going to help, because money transfer is payment system to enable people to pay, to transfer money and so on. But it doesn't lead to savings. You want to combine the two. Those who are very far away use that medium of communication to send money and save probably with the bank where money sits. So people would look at a bank with more confidence compared to a telco, which is meant for making people talk or send messages or WhatsApp and that kind of stuff.
So I would actually take issue with that a little bit. I think one of the reasons that M-Pesa was successful was that people had been saving with Safaricom and whatever it was called back then. I forgot Celltel, and before that Kencell. They've been saving with telecommunication companies for a long time. That's because the credit was prepaid. You had to buy a scratch card, and you could use that money and that credit over time. Now these weren't long-term deposits; they weren't long-term promises, but they were promises that were kept. The telecommunication company was able to put your call through, was able to have your SMS sent days and weeks after you purchased that credit. So I think that built some trust early on that this money was not going to be stolen, that it was there. And maybe the good thing was they weren't thinking of it as money in the bank, they were thinking of it actually something on their phone, even though it wasn't. Right? They thought it was there, so they thought they could keep it and hold it. And that, I think, and people still ask me, how do I put the money into my phone? So that may well help with the trust.
Yeah, I made the point earlier, but I think it's worth stressing, and that's the human intermediary and the role going forward that they're going to play in developing that trust. And a lot of discussion this morning about financial literacy. And we did a savings study a few years ago here, and we found that roving agents who were trusted community members were actually incredibly good at getting people to save on their mobile, and they were usually people who worked in the agricultural community, who had some sort of an extension role, so they were known to the communities, so they were leveraging their own trust with the people they were serving. Now, because it's more of a relationship business, they actually had to go 3 times to visit those communities before they would convert on a savings account. So again, moving away from the transactional payments type of model to more of a relational, and thinking about mobility so we can reach further at lower cost to more further to reach communities.
Wonderful. So one final question to wrap up. Thinking 10 years ahead, what would be one indicator that you think has either a good likelihood of moving or that you would like to move aspirationally in the financial sector in Africa? a decade on, what is one indicator you want to see having moved?
Definitely, just greater access to to savings accounts among young people. I think there's a lot of institutional barriers that are there. We're coming up with all sorts of innovations and strategies to from the demand side to try to help young people access financial services. But there have to be some changes at the institutional level, at the regulatory level, to make that access easier. So 10 years from now, I'm really hoping that we'll see significant changes.
Yeah, go on.
I want this to be so rare, it's worth $1,000 and not 1,000 shillings.
I think what he's talking about is the thing we want to see so that people believe less in cash than other payment systems, so that, because at the moment people want to do everything in cash. You want to reach a level where they can use other evolved payment systems. That's when we will know that their aspirations have changed and their trust in the financial sector has shifted.
Okay, I'm going to assume that there are a lot of people who are connected to the financial system 10 years from now. I'm going to assume that they have very interesting products in their hands, and I think we talk, having a portfolio of products, being able to personalize those, because now we have a technology that allows you to pick and choose. And my colleague Henry is going to talk about this a little bit tomorrow with regards to commitment savings and the product we've been developing. So I won't steal his thunder, but I think there's a lot of opportunity there to let the client on the demand side actually choose their own experience, and that will be exciting, because I think, as we know from various studies, or very vigorous financial actors choosing many different sources, and I don't think the current product space has served them with their needs, and so letting them be empowering them to actually make those choices themselves is going to be an incredible opportunity in 10 years' time.
Fantastic. And I'll add my last 1 cent, which is, if I think 10 years down, I'd love to see total, like a big rise in sort of accountability of the consumers, who come from poorer backgrounds, being able to demand the same kind of service delivery that we at least try to demand from our service providers, and that will require many kinds of things to transform. But thank you so much, Rossana, Billy, Fabian, and Sean, for your wonderful comments and for this discussion, and I hope everyone enjoyed it as much as I did. Thank you.